Good morning, good afternoon, and good evening, everyone. Welcome to the second day of our IAIS Global Seminar. My name is Romain Paserot, and I am the IAIS Deputy Secretary General and Head of Capital and Financial Stability. Today, we will hear from the chairs of 3 of the IAIS committees about the work they have been doing over the last 6 months and their plans for the remainder of the year. First, we will hear from Hendrickx, Chair of the Macroprudential Committee, followed by Matt Walker, Chair of the Policy Development Committee, and last but not least, we will hear from Peter Bromüller, Chair of the Implementation and Assessment Committee. Today's session is a format that we are using to increase our engagement in response to your feedback. Each committee chair will make opening remarks of 10 minutes, and then we will allow for around 15 minutes of Q&A following each presentation. Some housekeeping details for the Q&A part of the sessions. Please either send us your question in the chat, we will then read the question and ask for the floor, or ask for the floor, in which case we will upgrade you to become a speaker. Take note that it will take us a moment, approximately 15 seconds, to upgrade you as a speaker so you can speak. During that time, please stay on mute. Once you have been upgraded, we will ask you to please state your name, organization, and your question. You can then unmute yourself and turn on your camera. And with that, I would like to hand the floor to Hendrickx. Dieter, the floor is yours.
Thank you very much, Romain, and hello everyone, and good morning, good afternoon, good evening also from my side. I will try to give you an update today of the different activities of the Macroprudential Committee at IAIS. Some of our work was already discussed or highlighted yesterday during the leadership dialogue. I'm sorry, but I hope to give a bit more details on our different projects today. Now, let me start with some advertising and provide you with an update of our global monitoring exercise. We have given a flavor of a preview of outcome of this year's global monitoring exercise in our mid-year Global Insurance Market Report, or GMAR, which was published on the 26th of June. For those of you who have not read it yet, the report can be downloaded by scanning the QR code that you see here on the screen. Now, as background information, and we can move to the next slide, and as most of you know, the GME builds on data collected from around 60 of the largest international insurance groups, as well as 50 supervisors around the world. All in all, that allows us to cover more than 90% of global gross written premium, which, as I said before, make it in all a very representative exercise at global level for the insurance sector. GME outcomes are discussed at the Macroprudential and the Executive Committee at IAIS before they are reported. There is an annual reporting, for instance, to the Financial Stability Board. This process, of course, also shapes potential future work of the IAIS. In 2025, we will hit another important milestone here, as the FSB will review again its experience with the process of assessing and mitigating systemic risk based on a holistic framework. GME outcomes are also reported to participating insurers and supervisors, and aggregate findings are also discussed to the public in the year-end GMAR. Later this year, the IAIS will also publish a GMAR special topic on the potential financial stability implications of natural catastrophe protection gaps, focusing on how these gaps could, via different transmission channels, affect the financial system and broader economy, including banking, real estate, households, and government finances. I can also share again the themes which will be in focus of our 2025 GME. We have geoeconomic fragmentation and how this impacts insurers' management of assets and liabilities. We have insurers' increased investments in private credit. And last but not least, insurers' adoption of governance of artificial intelligence. Now, let me share a few preliminary findings of this year's GME data analysis. We have seen how solvency and profitability positions remained stable in 2024, underscoring again the sector's resilience. Strong operational performance and organic capital generation have continued to help offset challenges from volatile interest rates, market fluctuations, and geopolitical tensions. Also, liquidity positions have improved for many insurers due to portfolio adjustments, reinsurance transactions, and higher remittances. Though some insurers have experienced a declining liquidity position, mainly explained by increased dividend payments, share buybacks, and increased allocations to illiquid assets. Aggregate systemic risk scores, which we've highlighted here on the graph on the slide, remained stable in 2024, albeit reflecting mixed developments across the underlying indicators. We've seen declining scores driven by reduced minimum guarantees on variable products and a slight drop in derivatives-related indicators. On the other side, we've also seen increases stemming from a rise in intra-financial assets. Now let us zoom into the three different themes which I've mentioned before and which will be in our focus for the 2025 GME. Turning to the first theme, geo-economic fragmentation and how this impacts insurers' management of assets and liabilities, we see how geopolitical risk has different ways to manifest itself, spill over to macroeconomic and financial risk, and ultimately be transmitted to the financial sector in general and the insurance sector more specifically. The IMF has warned that geo-economic fragmentation in general could dampen economic growth prospects and trigger a retreat from international cooperation, threatening overall global resilience. All this points to the importance of robust risk management frameworks. We've seen measures taken by insurers and reported as part of the GME that include asset reallocations, establishing exposure limits, scenario testing, and crisis response planning, as well as sometimes we've also seen how underwriting strategies have been adjusted. IAIS will of course continue to explore the potential mechanisms through which geoeconomic fragmentation may transmit risks to the insurance sector. As you can see, the specific areas of attention listed on this slide below, such as credit risk, exchange rate risk, liquidity risk, and underwriting risk. Let us move to the second theme. This second theme focuses on increased insurers' investments in private credit. The 2021 to 2024 GMARs have already provided an in-depth analysis of two key structural shifts that we've noticed in the life insurance sector: the increased allocation of capital to alternative assets and the increased use of cross-border asset-intensive reinsurers. Continue this work, the IAIS has developed a draft issues paper on these structural shifts, which I will come back to later. Now, in the 2025 GME, the IAIS will perform a specific analysis of insurance investments in private credit, a rapidly growing subsector of alternative assets with unique characteristics. Some examples of benefit and supervisory concerns associated with alternative assets in general are shown on the slide, but the idea is now to deep dive a bit more into the aspects for private credit. Next slide. Finally, theme 3, we will try to capture insurers' adoption and governance of artificial intelligence. We expect the deployment of AI to have a material impact on social and economic activities. For insurers and their consumers, AI presents both opportunities and risks, which need to be effectively managed. Recognizing this, the IAIS has increased the focus on AI, looking at issues both from a risk management perspective within the MPC, but also in supporting supervisory practices, which will be covered by my fellow committee chairs later today. The 2025 GME will zoom into insurers' adoption of governance of AI. Two dimensions which we will try to capture. First of one, insurers' own risks, the impact of AI on processes, and secondly, how AI may impact the balance sheet of an insurer. Key areas of focus will be around adoption of Gen AI, including a focus on leading use cases, the drivers for AI adoption, governance frameworks which are used for AI management, AI third-party dependencies, and service provider concentrations and potential consumer impact. Next, I will end my presentation with an update on two public consultations. The most famous one, I guess, is the recently published public consultation on the draft issue paper on structural shifts in the life insurance sector. I would once again like to thank stakeholders for the valuable contributions we have received through this public consultation. This issue paper has benefited from significant stakeholder interest, which we will try to take on board now to further refine the paper going forward. We aim to finalize the paper by the end of this year. As already highlighted, the objective of this issue paper remains to clearly spell out the issues identified, cover the benefits and the risk of the different trends and the related supervisory responses, in order to inform the future work of IAIS on this topic, which could include making potential enhancements to the IAIS supervisory material and supporting material that comes along with that. We have also launched a public consultation on the updates we envisage to make to our methodology to assess the build-up of systemic risk within individual insurers as part of our IAM monitoring in the GME. This consultation was launched on the 19th of June and remains open until the 18th of August. Again, I look forward to also receiving valuable stakeholder input on this public consultation. Important areas of the methodology that we will tackle are the way, for instance, we measure the level 3 asset indicator, trying to make it less sensitive to accounting changes. But we will focus also on other indicators, including intra-financial assets and liabilities, and we will have a look at the way we score asset liquidations. Other changes cover the selection criteria for insurers that are to be included in the insurer pool. And we also try to look at indicators that we need to change in terms of weighting under the assumption that the underlying indicator could change. We will also have another look at the denominators we use. All this will result in an updated methodology, which we hope to publish as part of an updated GME document, which is expected by the end of this year. With that, Romain, I can stop here and I'd be happy to answer any questions there may be. Thank you.
Yes, thank you very much, Dieter. Thank you for this presentation. So now it's the time for the Q&A session. So as I mentioned, please send us your question via the chat or let us know that you would like the floor. You can mention that also in the chat. So I see that we have a first question. For you, Dieter. So I'm reading it. So the IAIS work on structural shifts in the life insurance sector is very topical. How is the IAIS assessing macroprudential risks arising from life insurers' growing exposure to alternative assets, such as private credit, and notably the increased interconnectedness with non-insurance financial entities?
Thank you, Romain. Not the easiest question, and I would say one where I would like to cover a few aspects. First of all, I would like to highlight that the IAIS in general, as most of you will already know, is actively monitoring risks, including the macroprudential risks arising from life insurers' growing exposure to alternative assets. And often this is also linked to their increasing interconnectedness with non-insurance financial entities and the real economy in general. Now, through the global monitoring exercise and insights from the issues paper, which I previously referenced, we have already tried to cover the main benefits and risks linked to this trend, with a particular focus on aspects such as valuation uncertainty, illiquidity, and hidden leverage. Aspects which have the potential to amplify vulnerabilities during periods of market stress. And also these three aspects have helped us as a supervisory community to have a better common view and understanding of this trend. Now, as already outlined in the issues paper, the structural shifts have highlighted, I think, again, how the insurance sector is linked to several key participants in the financial system and the real economy in general. Allow me to give a few examples. First of all, we've seen how alternative assets can be very important to fund vehicles for real economy borrowers, such as infrastructure projects, real estate project funding for corporates and even consumers. We've also seen how life insurers, through their long-dated commitments with policyholders, have a direct impact in the real economy, influencing pensioners and impacting their savings. We've seen how life reinsurers, on the other hand, through asset-intensive reinsurance transactions, provide important commitments to a number of insurers across the globe, increasing also the links within the insurance sector. And last but not least, I think both life insurers and reinsurers have shown an increasingly connected way of being connected to different financial market participants like banks and alternative asset managers, either as providers of finance, for instance, or through distribution of risks and investments. Now, as a consequence, we need to be aware that potential disruptions in the life insurance or reinsurance sector could be transmitted to the financial system and the real economy in general. Potential systemic risk implications from all of this, particularly from the interconnectedness with other entities in the financial system, like private equity players and/or asset management managers, have been an important focus of, for instance, our issues paper due to the potential for contagion risks. Stresses in the alternative asset markets or in the life insurance sector could as such be transmitted to the real economy and financial system, and we need to understand the way this could happen, for instance, under which scenarios, and what this materiality is to be able to set up an adequate supervisory response in case we would need to react as supervisors. The draft issues paper outlines 3 key risks from a macroprudential perspective. We have looked at what could happen in case insurers would be forced to liquidate their assets in times of stress. We have considered a scenario where there would be a rapid pullback of insurers from key lending markets due to defaults and downgrades. And last but not least, we've also looked at the impact of financial market disruption from a mass recapture of asset-intensive reinsurance transactions by one or different insurers. Now, I want to stress that so far we have concluded that due to the limited size of the current exposure to alternative assets and asset-intensive reinsurance, the risk to global financial stability remain limited. But that doesn't mean we do not need to understand potential dynamics and impacts as supervisors. We have seen, by the way, how stress testing, improved data collections, and cross-border supervisory cooperation are key to help us address the challenges. Now, on private credit more specifically, as previously highlighted, it is and will be a specific theme in focus of this year's IAIS collective discussion and GME, and that fits, of course, our broader focus on several types of alternative assets. Our analysis will be based on the data that we collect through the GME, and the upcoming period of the feedback loop, both with group-wide supervisors, but also with individual insurers over the period July-August, will be important here. Our GME findings will, by the way, also be reported to the Financial Stability Board, ensuring global coordination in addressing these risks. Now, looking ahead, I can end with highlighting that the IAIS will publish its 2025 GMAR and the final version of the issue paper later this year. And I hope all this will serve as the basis for informing the next steps in terms of supervisory and regulatory responses as a reaction to these evolving risks. I'll stop here, Romain. I hope there was a comprehensive answer.
That was definitely a comprehensive answer. Thank you very much, Dieter, for that. Let me check if there are any other question on the chat or anyone willing to take the floor. This is really your opportunity to ask a question to Dieter on these very important topics. I don't see anyone. Don't be shy. All right. There doesn't seem to be any more question for you, Dieter. But it's not completely over because you will be back tomorrow for the panel on the key risk in the global insurance sector. So you will have also the opportunity with your panelists to address some of the issues that we have discussed today. So thank you very much for your presentation, Dieter.
Hello and welcome back, everyone. Welcome to the second Committee Chair engagement session. My name is Hanne van Voorden and I'm heading the IAIS Supervisory Practices and Operations team. I will just briefly remind everyone about the structure of the session and how we will handle the questions and answers. Matt Walker, the chair of the Policy Development Committee, he will begin with a 10-minute presentation on the committee's work, and after that we will have about 15 minutes for questions and answers with you. You can send your question either via the chat function, or you can let us know that you'd like to take the floor, also via the chat. So without further ado, I will now hand over to Matt for his opening remarks.
Thank you, Hanne, and hello, everyone. I'm really honored to be able to be here today to represent the IAIS's Policy Development Committee and tell you a little bit about both what we've been doing and what we have planned. Before we begin, though, I need to give a short disclaimer that I'm speaking to you today in my capacity as chair of the Policy Development Committee, and my reviews should not be understood as those of my employer. Also on the line from PDC are Vice Chairs Paolo Cardoni and Ricardo Garcia. We operate very much as a team, so you'll probably hear them coming in response to questions. Turning to the first slide. And as always, let me begin with the insurance capital standard. Last December, the IAIS adopted the ICS and completed its comparability assessment of the US's aggregation method. The IAIS's adoption of the ICS was a major milestone for the IAIS and for the global insurance sector. The ICS provides a globally consistent, risk-based measure of capital adequacy for IAIGs and forms the quantitative element of the common framework for the supervision of IAIGs, or ComFrame. The ICS was designed for jurisdictions to implement it as a group-wide prescribed capital requirement, representing a solvency level below which supervisors would intervene on group capital adequacy grounds. The ICS promotes IAIGs maintaining sufficient capital to withstand potential stresses and provides a globally consistent framework that supervisors can use to evaluate the capital adequacy of these groups. Currently, we've identified 60 IAIGs from 19 different jurisdictions worldwide. By definition, as IAIGs, these groups operate across several jurisdictions, which makes it really important for supervisors to have a common language that we can use to discuss the capitalization of these companies, as well as a common minimum standard for that capitalization. Now that the ICS is adopted, we're working to facilitate its implementation by members. We're currently working on several important ICS-related supervisory and supporting materials. All of these will be subject to consultation, and we'd welcome your input. First on that, and the one we've been spending most of our time at PDC, is on reporting. The most on this subject is on reporting and disclosure. We're developing new ComFrame standards for the ICS within the ICPs on what information should be reported to supervisors on capital and what information will be disclosed to the public. Those are in ICPs 9 and ICP 20, respectively. As we're thinking about it, what gets disclosed to the public in ICP 20 will be a subset of what is reported in ICP 9 to supervisors. We plan to release both of these potential plan revisions later this year for consultation. We're also working on an application paper on the availability of capital. That paper will aim to share experiences on how group-wide supervisors address availability of capital issues in their group supervision, particularly when applying a consolidated group capital standard, such as the ICS. Those of you who have been around the IAIS for a while may remember this issue coming up repeatedly as we were developing the ICS, so we're happy to be able to come back to it. This paper will go through the various ways that this comes up, including due to legal entity restrictions or capital not being paid up, and share information about different supervisory practices around the world to address these issues. Turning to the next slide. The biggest issue for PDC over the last several months is just trying to bring clarity to how the ICS will be assessed. We've previously heard comments from our members and from many of you stakeholders on the line that they want clarity about how the ICS will be assessed. So we've really prioritized that. We've made good progress. Last month, we agreed on the high-level principles, or HLPs, for the ICS implementation assessment methodology. These principles will primarily serve as guidance as we develop the full ICS implementation methodology. Importantly, on the principles, I do want to emphasize that our ICS implementation standard will not be a line-by-line assessment like what we do for many other standards, but it will still be designed in a way to serve its purpose as a minimum standard and as a common language for the supervision of IAIGs. There are 6 different ICPs. You can see the subjects on the screen. I'm not going to go through each of these, but I will highlight a few of them in particular. HLP2 covers the different components on which we'll be issuing ratings. These include things like valuation, capital requirements, and capital resources, as well as general sections. HLP3 deals with identification of deviations and the recognition of offsets within those components. So something like if a jurisdiction were higher on capital requirements in one particular area and lower in another, HLP3 deals with how we would think about the offsets between those different items. HLP5 covers how we go from those component ratings to an overall rating and the recognition of offsets across components. So this is something like a jurisdiction being perhaps more conservative on valuation and maybe less conservative on capital requirements because of that. That kind of offsetting would come up under HLP 5, and you can see what we plan to do about it there. As we've said before, we'd really welcome your engagement on these items as we go from the HLPs to the more detailed methodology and as we develop the self-assessment questionnaire. We've been working out some of the details on how we will do that engagement. As a next step, we're going to be setting up a dedicated virtual event on this on September 9th to get your input. Please be on the lookout for that, the invitation. I understand it'll go out later today. I do want to highlight that that sort of engagement will really differ from a lot of the other IAIS engagements you've been to. Here today, we're mostly communicating information. It's mostly you're asking questions and are answering them to try to bring clarity. On this upcoming stakeholder event, we're really looking to get your input as we're at an earlier stage of developing this. We'll be looking for people to provide views as part of this session. So if you are interested, please consider volunteering to give views as part of that. There'll be more details as the invitation goes out. That's all I'll say about the ICS implementation assessment. For now, I think Peter will come back to that in his portion later, so stay tuned. Turning to the next slide. While establishing standards is critical, it's not the end of the story. The standards only matter if they're implemented, and supporting materials are designed to help with that. Recently, we finalized 3 different application papers that we consulted on last year. You can see the list of those on the left side of the screen. One of those is on the supervision of climate-related risks in the insurance sector. This was a comprehensive update of our prior application paper on the subject, which discusses how the IAIS existing standards apply to climate-related risks after our limited updates to that supervisory material last year. Another the application papers is on supervision of artificial intelligence. This paper reinforces the importance of existing ICPs. For example, it discusses how ICP 8 on risk management internal controls applies, which is similar to the issue I heard Dieter talking about in the GME this year on the governance frameworks for AI, which has been a hot topic recently. It also discusses ICP 19 on the fair treatment of consumers and how AI affects that. On the issue of fair treatment, we also have a 3rd application paper on the fair treatment of a wide range of consumers. ICP 19 establishes the expectation that insurers and intermediaries treat their customers fairly from pre-contract to fulfillment of all obligations. That expectation is at the center of conduct supervision and is an important part of fostering trust and confidence in the insurance sector. Also recently published is the draft application paper on operational resilience objectives and toolkit for public consultation. You can register for the July 17th public webinar on our website, and we look forward to receiving your comments by September 29. In the area of recovery and resolution, we're working on updating our existing application papers to provide further guidance on the relevant updated ICP and FSB to ensure alignment with their material, and we'll publish that for consultation in Q4 2025. Before I conclude, I want to mention a few other important areas of ongoing work. Members, particularly from emerging market and developing economies, have shared their implementation challenges of IFRS 17. The IAIS continues to monitor and support IFRS 17 implementation, including at a cross-sectoral level with the FSB, IMF, and Bank for International Settlements Financial Stability Institute. We continue engagement with consumers, groups, and which is held in 3 parts over the year. This engagement brings forward consumer representative perspectives and hence is an important complement to other IAIS stakeholder engagements. We've also been thinking about whether and how to further embed these perspectives in our governance process. There are also 2 new projects underway. The first is a new project by the Market Conduct Working Group, which is composed of conduct supervisors to explore supervisory issues associated with consumers receiving fair value from their insurance products. The second is by our Governance Working Group. It will develop member-only material aimed at supporting supervisors more practically to have effective engagements with insurers' boards and senior management on corporate governance topics. With that, that's all I plan to say, so I'll hand back, and I'm happy to take any questions you all have.
Thank you so much, Matt, for that update. Really, really helpful. So indeed, we will now open the floor for any questions that you may have. Just a short reminder, you can send them to us in the chat, or you can ask to take the floor also via the chat. We did already receive one question before, which was actually very related also to your topic just discussed just now, Matt, from Consumers International, from Stefan Hall. Stefan is not able to join us, so I will just read out his question now. As the IAIS explores the role of AI in insurance, how will you ensure that supervisory guidance addresses not just technical and prudential risks, but also looks at consumer outcomes? He mentions issues like bias in underwriting, lack of transparency in automated decision-making, but also access for vulnerable groups. Also, he wonders what plans there are to collaborate with consumer representatives and civil society.
Yeah, thanks. That's a good question. I think I want to emphasize that consumer outcomes are very important in this work. AI has the potential to have significant impacts both on society and as consumers on part of that. It's something we're taking very seriously. If you look at our recent application paper on AI, there's a lot of discussion on consumer issues. It's not all negative. AI has both benefits and risks. On the benefit side, you'll see discussion of financial inclusion, how the AI can lower costs and facilitate faster processes for consumers. But there are some risks that we want to keep in mind, including the possibility of pricing on factors that aren't related to costs, such as willingness to pay. You mentioned ICP 19. I've talked about that already previously on the fair treatment of consumers, and there is discussion on that in this paper on things like transparency and explainability. There's some good content. The supervisory guidance explicitly addresses the need for insurers to mitigate unlawful discrimination in AI system, ensure meaningful human oversight, and quite a few other things. I'd also emphasize that this is a rapidly changing area. AI is developing very quickly, and there's a lot of diversity in the different applications of AI and how insurers are using it. We want to promote a proportional and risk-based approach that really focuses on some of the areas where AI use is most impactful, including on underwriting and claims handling. One area I'd particularly highlight, because this is something that was discussed as we were finalizing it, is how AI can affect pricing and the potential that it could lead to much more granular and potentially much more accurate pricing. My background is an actuary, so I tend to think that these more accurate pricing is mostly a good thing, at least on the property side, to have premiums more closely tied to risk and give people an incentive to mitigate that risk. I would be remiss, and the paper does discuss that does come with some challenges, and it could really exacerbate insurability issues, particularly for people with higher risks. As far as the engagement with consumer groups, I did mention earlier that we have an engagement structured in 3 parts over the year. We very much welcome engagement from consumers on this and other issues, and happy to hear their perspectives, particularly if there's things they think we're missing on this. Thank you.
Thank you, Matt. Thank you, Matt, for that. I see also we have a question in the chat coming in from one of our members. It's about the updates to the ICPs on recovery and resolution planning. And the question is, as more insurers are required to prepare resolution plans, if there are any expectations for a more prescriptive report or any considerations on sources of information to meet those expectations?
Thanks. So we did modify the standards on those last year to bring more clarity on where resolution plans are required and to bring better alignment with the FSB's key attributes on this. The new standards do set expectations on insurers having a process in place for determining where these are needed based on some factors. Excuse me. I emphasize it's still, even with these changes, it's not a particularly large group of insurers that are subject to these. At a minimum, it's only any insurer that's assessed to be systemically important or critical if it fails. So I don't know, more is, I suppose, a relative term, but it's still not a particularly large group. In terms of content and whether it's prescriptive, I would say most of the IAIS material on this centers more on the who is required to prepare the resolution plan than on the what and the actual content in there. There's not actually that much, so I don't think it's prescriptive. However, the proportionality principle does apply to this requirement, and the supervisors can adjust this to their expectations as necessary on the detail on things like the risk profile and size and the activities of the insurer. Insurers are required to submit other information to the supervisors, both for the analysts and generally, and where applicable, any information from those other sources may be used in the resolution plan. We do hope to bring more clarity on this, though. Last year we got these standards done, but as I said earlier, developing the standards is only part of the story. We really want to see implementation and to help people do that and to give more guidance to other supervisors on this. We have these application papers. We're updating our application paper on this right now. We hope to consult on it later this year. We'd welcome any input on that, particularly if there are areas they think are unclear, if there's guidance. You mentioned this was from a member. If there's more guidance that our members want on these topics, we definitely welcome an engagement, and we'll take a look at that in the application paper. Thank you.
All right, thanks, Matt. Indeed, so stay tuned for that. Another question from also an IAIS member. It's on IFRS 17. So there was a question on what type of support the IAIS is providing for members who are considering or working on implementing IFRS 17.
So we've been serving as a forum for members to share their experiences with implementing this. Members, particularly from emerging market and developing economies, have shared their implementation challenges with respect to implementation of IFRS 17. And we continue to monitor and support the implementation. Recently, our accounting and auditing working group participated in an FSB roundtable on external audit and discussed the standards impact. And will contribute to the IAIS FSI IMF policy implementation meeting on 8th and 9th of October, focusing on IFRS 17 opportunities and challenges for EMDEs. We continue to collaborate with the IMF to deliver IFRS 17 technical training to its members, particularly from EMDE jurisdictions. So far, I think training has been provided to more than 500 supervisors from around the world as part of this. And there's more to come. I think there are 2 more trainings scheduled for later this year in Sub-Saharan Africa and Asia, from what I understand. So more to come.
All right, thanks, Matt, for that. I see a few other questions coming in on the chat. So one question was around the ICS. So does the IAIS intend to publish any public or market-facing Q&As or FAQs or guidance on the interpretation and implementation of the ICS? So I think you touched upon that already a little bit, but maybe you can expand a little bit, or perhaps one of the vice chairs would like to take this question. Yeah, we have put out quite a bit, and we've been working on more, including some technical stuff. I will turn it over to Paolo on this. He's really the expert. Paolo.
Thank you very much, Matt. I think we have received a few questions, and I think that depending on the type of question, we are assessing whether there is a need to make it more public. So expect some of the outputs of the Q&A process to become public shortly.
Thank you. And I may just stay on this topic because now I'm seeing another question on this as well. So Paolo, maybe also for you. A question from Hugh Francis. I understand there's separate work on ICS implementation issues to assist supervisors across different jurisdictions. And he's asking where items identified have broader market or company relevant interest. Would the IAIS consider making such implementation guidance also public, or would it stay for members only?
I think it'll have to be assessed on a case by case. So it depends on, I think, that the Q&A process and is helping us identifying and sifting issues or potential even mistakes we'll find in the level 1 and the level 2 text. So if that appears, we'll pass it to the appropriate governance and make public notifications.
Thank you very much for that, Paolo. Perhaps one final question that I saw coming in on the ICS, which is on the aggregation method. So whether it will be subject to the same assessment system and methodology as the rest of the ICS assessment, and notably around the line-by-line scoring principles that were set out in the HLPs that were published last week. I don't know, Matt or Paolo, if you want to say something on that.
I would just reiterate the prior language on this. We spent a lot of time as the organization on the aggregation method over the prior years doing the comparability assessment. We reached a deal on that last year. You can read we don't really have much more to say on the aggregation method at this point. You'll see what's in there on HLP 6 covers that, but not. Mostly we've been focused on the AM over the last several years, so it's moved on to other issues. For right now, we will come back and discuss in the future, though. Paolo?
I was going to defer to HLP6 like you did. And effectively, actually, HLP6 is quite clear on that it's the assessment of the implementation of ICS in the form of the US aggregation method is subject to the same methodology of the ICS, but complemented with specific list of instructions to reflect the different nature of the AM. And this work which is ongoing. So effectively, this is a part of the next stage of the work which will come with the implementation assessment methodology.
All right, thank you. So we also received a question on our on the final slides, Matt, that you were presenting the work of the Market Conduct Working Group and some of their new projects. One of them is around the new work they're doing on value for consumers, and I think we have Brenda on the line who was pleased to be asking her question live. So we'll give you a few seconds to show you on the screen, and then when you're unmuted, you can ask your question live. Thank you, Brenda.
Thank you. This is Brenda Cood in the U.S. and I just wanted to know more about what the intention is in terms of the desired outcomes of that work. Are there products intended?
In terms of products, so this is at an early stage. We've started to have some discussion of this on PDC as we're shaping it. The idea is that we just want to make sure insurers, we've heard from consumer groups about the different challenges of making sure consumers are getting fair value for their insurance products. So we're starting up a project to look at this. As far as particular products, we've had some discussion on that at PDC. I think there's a tension there to, because value means different things to different consumers, but it's something we're taking a look at.
Yeah, thank you, Matt. And I will perhaps just add to that, indeed, that it's really about really bringing attention to the issue of how insurance products can be designed in such a way that they really deliver something that is worthwhile for the consumer, and that may differ also depending on the product and depending on the consumer as well. But as you said, Matt, we have only just started that project, so we can discuss more on that in further engagements, definitely. So I think there might still be time for one final question. I'm just checking with my colleagues if there was any other questions we received. So one final question that we received was from Peter Kochenberger. It's related to, again, the issue of ICP 19, so consumer protection issues and AI in this case. So his question is, could you go into more depth on planned IAIS work related to a claim management function and relationship with AI? So I think that is a little bit related to ongoing work of the FinTech Forum. So it's possible that actually Peter Braumüller may go into that later in a few minutes from now. But Matt, anything you want to share on that related to the application paper we just published?
Most of the work on the AI is occurring under the IAC as part of the FinTech Forum. We've had limited engagement at PDC on this so far, so I would defer to Peter.
Thank you, Matt. And I can say that indeed the FinTech Forum has planned further engagement and especially on discussing with our supervisors on how they are addressing AI. So the work is not finished with publishing our paper last week. So with that, I would really want to thank you, Matt, and also Paolo and Ricardo for being on standby for any questions. And thank you to the audience for your very relevant and good questions today as well.
Hello and welcome back to the third and final committee chair engagement session for today. So we've already heard from Dieter and Matt on their respective committees, and we'll now have an opportunity to hear from Peter Braumüller, Chair of the Implementation and Assessment Committee. He will share with us the important work of the IAC that it's been conducting this year and provide an insight into what lies ahead. And just to remind everyone about the structure, we'll start with a 10-minute presentation, followed by a Q&A session with all of you, in which you can either send questions in the chat function or message us and let us know that you would like to take the floor. So without any further ado, I hand the floor to Peter. Thanks.
Thank you very much, Jonathan. Good morning, good afternoon, and good evening to all of you. It's my pleasure to present to you an update on the work going on in the IAC. Let me start with an update on our implementation assessment. The member assessment program, the so-called MAP, is an in-depth assessment of a member's implementation of the ICPs, similar to the IMF World Bank's Financial Sector Assessment Program, the FSAP. The MAP for the Sultanate of Oman concluded with the final report's publication on 27th of June. And meanwhile, the assessment of Costa Rica is underway, with the final report expected by mid-2026. We have also launched a peer review process, PRP, on ICP 13, which is on reinsurance and other forms of risk transfer, open to all IAS members. And a report with aggregate results and examples of supervisory practices will be published in Q1 next year. We are committed to implementation assessments in major insurance markets to ensure alignment with our standards. Last month, EXCO approved the individual reports of the 6 additional jurisdictions covered by the second phase of targeted jurisdictional assessments, the so-called TGAs on the implementation of the holistic framework supervisory material, namely for Australia, Bermuda, Italy, Singapore, South Africa, and Spain. An aggregate report with overarching trends and insights across participating jurisdictions will be prepared for publication. And the IAS will also monitor the progress being made in the other 10 jurisdictions that already participated in the first TGA tranche in addressing the identified gaps. And the implementation status of the holistic framework for all the 16 10+6 jurisdictions will be reported to the FSB later this year, followed by public communication. Let me turn to the ICS implementation. I think we have already heard something about that in the previous sessions. The IAS has established the following timeline for the ICS implementation. For 2025, the IAS is currently developing a detailed methodology for assessing ICS implementation, and this methodology will specify the level of granularity required and define the qualitative and quantitative analysis. We are also developing a self-assessment questionnaire to be used by IAS jurisdictions next year. The methodology and questionnaire will be based on high-level principles that are publicly available on the IAS website and were referred to in the previous sessions. In 2026 then, using the self-assessment questionnaire, the jurisdictions will conduct a baseline self-assessment to evaluate their progress in implementing the ICS. This will highlight readiness levels and areas needing additional support. And then from 2027 onwards, the IAS will aim to conduct detailed jurisdictional assessments of the ICS implementation. As part of this process, and this was also referred to in one of the previous questions already, the final aggregation method developed by the US as its implementation for the ICS will also be assessed. And the assessment of the AAM will be subject to the same timing as ICS implementation assessments in other jurisdictions, and to a consistent methodology, of course, including both qualitative and quantitative analysis, whilst at the same time focusing on the AM specificities. Let me turn to the work of the forums. The IAS has established 6 forums to provide members with an effective platform for peer-to-peer exchanges on various supervisory topics. These forums also regularly receive updates from stakeholders. In addition to the Financial Crime Forum, the Retirement Income and Pension Forum, and the Supervisory Forum, I would like today to underline developments in 3 other forums. In particular, first, on the 2nd of July, the application paper on the supervision of AI, just referred to in the previous session, developed by the FinTech Forum, was published. And this paper reinforces the importance of existing ICPs and promotes appropriate and globally consistent oversight of AI in the insurance sector. I encourage participation, as was already mentioned, in our public webinar that is scheduled for the 17th of July. Second, the Financial Inclusion Forum focuses on the role of inclusive insurance markets in promoting financial well-being and societal resilience. The fifth is currently working on finalizing the draft of the application paper on inclusive insurance that reflects changes in the regulatory landscape since its original publication back in 2012. This is being developed in close collaboration with TIGAP within the World Bank Group, with a public consultation planned for later this year. And last but not least, the Risk-Based Solvency Implementation Forum provides guidance to insurance supervisors from EMD jurisdictions on implementing RBS regimes. Last month, we published a guidance paper on how to implement RBS regimes, and particularly in EMDE markets, which has been very well received by EMDE members. Let me turn to protection gaps. The rising frequency and severity of natural catastrophe events is impacting the availability and affordability of insurance coverage, which leads to protection gaps. The IAIS is actively supporting work to address these gaps, including helping to drive a collaborative approach among stakeholders. Most recently, the IAIS contributed to the G20 Sustainable Finance Working Group under South Africa's G20 presidency. This work has been undertaken jointly with the World Bank and will be published soon. I also invite you to join the panel session on NatCat protection gaps tomorrow. The G20 input paper discusses multi-party solutions for NatCat insurance protection gap, offering possible actions that can be taken by various stakeholders, stressing the importance of collaboration among governments, supervisors, and all other stakeholders. Building on the paper, the IAIS plans to develop a practical resource to assist policymakers and supervisors in addressing NatCat protection gaps. Lastly, let me turn to supervisory capacity building. I would like first to thank our implementation partners, the HYI, the FSI, the IAA, and Toronto Centre, for their critical role in supporting our work. For the second half of the year, we are working with our implementation partners to deliver training programs, including the FSI IAIS Regulatory and Supervisory Online Program, known as the First One, and policy implementation meeting on the IFRS. We continue working with the IMF to respond to the growing demand for IFRS 17 related training. Following HYI's transition to CGAP earlier this month, programs such as the Inclusive Insurance Training, Actuarial Skills Program, and the e-learning platform will continued by partners such as the Toronto Centre, the International Actuarial Association, and the Frankfurt School of Management and Finance to strengthen our support to the supervisory community. In closing, the IAIS remains committed to fostering strong implementation of global insurance standards, advancing supervisory capacity, and addressing critical challenges Through collaboration, peer exchange, and targeted initiatives, we continue to support our members in navigating a rapidly evolving insurance landscape. Thank you very much for listening. I look forward to your engagement. Thank you very much.
Thank you very much, Peter, for that comprehensive update, and thank you also for your leadership on these topics, which has really been taking things from strength to strength, as well as the leadership of Connor Donaldson in the Secretariat Management team, who couldn't be with us today. Great, we'll now open the floor to questions, and let me go straight to a first question, which is from Nick Dexter from the International Actuarial Association. Nick cannot join us today live, but he has shared his question in advance, which I'll read out on his behalf. So to Peter, we note that the IAIS is continuing to develop firstly technical notes on ICS implementation, which was covered a bit by Matt, but secondly also practical aspects of implementing risk-based solvency regimes, building off the guidance on this topic that was published a couple of weeks ago. Are there any aspects of this work where input from the IAA would be helpful?
Good question. Let me start with just telling you, not surprisingly, that standard setting work is followed by standard implementation work and by standard implementation assessment work. So now the ICS is adopted and the IAIS is working on its proper implementation. And the technical notes, which you reference, provide examples and explanations that were used during the field testing and monitoring period, annual data collection exercises to help volunteer groups understand the technical specifications. When we adopted the ICS, the level 1 and level 2 texts contained only the standard. Accordingly, providing these examples should be helpful in supporting implementation. We have reviewed them and are now publishing them in these so-called technical notes. So that should bridge the way from a standard setting and having standards into the implementation. And also beyond this, we are currently working on several important ICS-related supervisory and supporting material that will be subject to public consultation either this year or in 2026. And stakeholders' input, including the IAA, on those items will really be very useful. Firstly, we are developing new COM-frame standards for the ICS within the ICPs on supervisory reporting and public disclosure. So this means ICP 9 and 20. And the public disclosure standards will be a subset of the standards for supervisory requirements in line with their different objectives. Also, we are working on an application paper on availability of capital whose objectives is to share experiences on how group-wide supervisors address the availability of capital issues in their group supervision, particularly when applying a consolidated group standard such as the ICS. This paper is also expected to provide examples of how supervisors address cases of double or multiple capital gearing in the absence of fully consolidated group standards, where intergroup holdings or of regulatory capital may overstate the overall group capital position. Developing actuarial capacity is a key priority identified by our members for a successful implementation of a risk-based solvency regime. And this need is particularly pronounced in emerging market and developing economies, where actuarial expertise is often more than limited. The partnership agreement between the IAA and the IAIS has provided a strong foundation for leveraging actuarial expertise to support supervisors in this critical area. As we continue to deepen our focus on implementation, we look forward to collaborating further with the IAA to enhance our support to supervisors. And building on the existing program, we aim to address key areas where supervisors have expressed the need for additional assistance. This includes the implementation of ORSA, tackling challenges related to IFRS 17 in the context of risk-based solvency framework, and developing key performance indicators. We are looking forward to engage with the IAA on these topics through our risk-based solvency implementation forum over the next few months.
Great, thank you very much, Peter. And we have a next question, which is from Dennis Noordhoek of the Geneva Association. And perhaps whilst we tee up Dennis, just to say from my side as well, a very big thank you also to our partners at the IMF, who were co-drafters of that guidance on implementing risk-based solvency regimes. And if you haven't seen it, I think it's an incredibly helpful handbook, which really talks about how to calibrate that risk-based solvency regime based on a number of factors, but which includes the sort of level of technical expertise within the supervisor, within the industry, and really helps to identify those areas where we do need to work on additional capacity building. Do we have Dennis with us?
Thank you, Jonathan, and thank you, Peter, for the comprehensive presentation. And I just want to follow up on one of the points you mentioned on protection gaps. So insurance fundamentally strengthens society's resilience by managing, pooling, and diversifying risk. And to fulfill this purpose, especially for vulnerable communities, insurers need to offer or need to be able to offer inclusive products whose design, distribution, and servicing meet consumers' or customers' need, and therefore help to close protection gaps. You already briefly mentioned the protection gaps, not least in relation to NatCat and the IAIS Call for Action paper, which I think is from late 2023. Now, following up on that, what specific activities has the IAIS planned to support this initiative and to support this objective? And what work is the IAIS doing or planning in relation more specifically to the growing protection gaps in the life and retirement sector, where I believe one of the biggest and largest protection gaps loom? So thank you very much for shedding some light on that.
Thank you very much, Dennis, for the question. Let me start with where this all finds its basis. It is our IAS 2025-2029 strategic plan. And in this plan, the IAS identified the societal role of insurance in supporting resilience. I think a very key element and a major step forward compared to previous strategic approaches. This theme allows us to look holistically at issues that contribute to protection gaps, considering all the factors around, such as the impact of digital innovation, climate change, aging populations. So this is a very, very broad subject. Currently, the NatCat protection gaps remain a priority for the IAS and our members, as set out in our 25-26 roadmap. And in developing our next roadmap for 26-27, the IAS will consider whether to undertake further work on other protection gaps, not to forget them at the same time. The IASIS, and I mentioned briefly in my presentation, the Retirement Income and Pension Forum has considered different elements of retirement protection gaps in recent meetings. It looks at both trends, such as longevity and also product developments. For instance, it has considered the adequacy of retirement income, pensions and women, access to advice, long-term care insurance, and the impact of cost of living pressures on pension savings. The Retirement Income and Pension Forum has benefited greatly from the presentations we have received from the Geneva Association and other trade associations and insurers. So you see it's already getting more intense and more broader also on the other type of gaps around. And the intention of the forum is to continue to function as a forum which provides a platform for sharing information and discuss supervisory practices and challenges on this issue, and therefore it does not undertake policy work. We also will leverage on the engagement with the OECD and the IOPS, the International Organization of Pension Supervisors, to ensure we are considering these issues holistically across the supervisory and regulatory community. So a lot going on, but certainly you will see much more in our next roadmap for 2026 and 2027. Thank you.
Thank you, Peter. Let's move straight to the next question, which is from Mary Frances Munro. Mary Frances isn't with us live, but I'll read out her question, which is around the implementation assessment issues. Specifically, what are the key and new areas of macroprudential focus in the second round of targeted jurisdictional assessments of the implementation of the holistic framework supervisory material? Peter.
Yeah, thank you very much. Just to make clear again that the 2024-25 Holistic Framework Implementation Assessment builds on the 21-22 targeted jurisdictional assessments and includes, in addition to the 10 already covered then, 6 other jurisdictions. As I mentioned, I think Australia, Bermuda, Italy, Singapore, South Africa, and Spain. And this second phase evaluates their progress in implementing supervisory measures under the holistic framework to address systemic risk in the insurance sector. And the assessment covers, in principle, the same areas and follows the same approach as in the first assessment, done a few years ago, but just for different jurisdictions. And why did we do this? Because we believe it's also important to ensure consistency in our assessments across the first and the second TGAs. Because if they are then reported together, it should be on an equal basis, on a comparable and consistent basis. And as a reminder, what these objectives of the TGA were: first, to assess the observance of the material aspects of the HF supervisory material in the participating jurisdiction and identify any gaps or challenges in the implementation process, similar to the previous TGA. And secondly, to contribute to IAIS reporting to the Financial Stability Board on the implementation of the HF and to help inform the FSB's review in 2025 of its endorsement of the HF. So it's a critical phase for us still to continue to prove that the holistic framework is working well in practice and delivering what we want it to deliver. So this is a major part that we can report on, I think, a very broad and deep assessment of 16 jurisdictions altogether. And these assessments cover key macroprudential standards under ICP 24, including data collection and analysis, assessment of the systemic importance of insurers and the sector, supervisory requirements for macroprudential purposes, and finally also transparency. The DGAs analyzed how supervisors apply enhanced frameworks using qualitative and quantitative criteria, such as size, interconnectedness, and substitutability, to tailor supervisory measures to insurers' systemic footprints. Jurisdictions are using a variety of macropotential tools such as stress testing, scenario analysis, and sector-wide assessments. Another key focus was the identification of and the additional requirements for the International Active Insurance Group, our so-called IAIGs. And this involved the application of CAMFRAME standards, which are tailored to their global operations. And these standards include measures such as enhanced liquidity risk management. Finally, assessments evaluated jurisdictions' progress in strengthening recovery and resolution frameworks to improve preparedness for managing insurers' distress. And the IAIS will publish the TGA report on the implementation of the HF supervisory material in the first quarter of next year, providing an overview of progress, best practices, and areas for improvement. Back to you, Jonathan.
Great, thank you, Peter. I think we have time for one last question, which is from Anthony Konon from CGAP, heading up now the Access to Insurance Initiative activities. And Anthony, I think we can move live to you for your question. Thank you.
Thank you very much, Jonathan, and thank you all for allowing me to engage. I actually wanted to ask you, Peter, what your expectations are of the implementation of the Cape Town Declaration of Inclusive Insurance, the declaration that was announced at the December IAIS annual meeting, and which we at CGAP will look very much forward to activating with all the members of the IAIS. So I'd really like to hear what your expectations are of that. Thank you.
Thank you. Thank you for that, Antonique, and welcome. And thank you for taking over, CCAP taking over the further development of the Cape Town Declaration. In short words, the Cape Town Declaration for me is an instrument that should give further momentum to the process of leading to more inclusiveness in the insurance sector, to leading to more financial health, and addressing the needs of vulnerable people. And in a way that is encouraging those who want to do something to find a platform for doing that, to find a framework for doing that, to find support for doing that, but at the same time also to express their commitments. So that commitment is not just to do something, but really to have concrete commitments and make progress. So my overall expectation would be that through the Cape Town Declaration, we will see a further spread, a visible and tangible further spread of inclusive insurance on a global basis.
That's great. Thanks, Peter. And maybe just to add, those of you who weren't there in Cape Town at the inaugural meeting of the on the Cape Town Declaration on Inclusive Insurance, I think it was a very good start because we had representatives from 26 jurisdictions representing a population of more than 3 billion people at that meeting, and really putting their hands up to take a very active role in promoting inclusive insurance in their markets. So thank you to CGAP as well for taking that forward. So that brings us to the end of today, and thank you very much, Peter, for your presentation and insightful answers, but also to everyone joining today's session, for watching, providing us with your great questions. We're approaching the end of the IAC session for today, and in fact the end of the second day of the global seminar. So on behalf of Dieter, Matt and Peter, as well as Romain, Hanne and myself, thank you very much for joining us for some important and engaging discussions. We hope you found today's sessions useful, and we look forward to hearing your feedback.